Jonathan Garner, Chief Asia and Emerging Market Equity Strategist with Morgan Stanley, joins us live from Hong Kong via the Skype link. Jonathan, always a pleasure to have you back on ET Now. Thank you for joining us. Let's start with something which is fresh off the press. FOMC minutes for the September meeting are out. What do you make of the fine print? Because the devil is always in the detail.
Well, I think it shows that the decision not to taper was quite a close call. I think that's the phrase that they're using. And when we look forward, we're now of the view, given the government shutdown and therefore the lack of economic data from the United States, that the committee is actually unlikely to taper even later this year at the December meeting. And so tapering is still on the agenda. We know the FOMC wants to adjust monetary policy, but it's probably on the agenda for the first quarter of next year rather than this year.
If the logjam in the US Parliament and shutdown and debt ceiling, Jonathan, is going to last a little bit longer or get stretched, do you think that is going to be damaging for emerging economies?
Well, you could argue that in terms of that linkage to the decision to taper, it's giving some breathing room. If we look at the really acute issues that countries were suffering in the third quarter, particularly what we call the Fragile Five, it was one of a situation of dollar strength, a very rapid backup in US bond yields, which was the result of a perception that the Fed was about to taper in September and also that the US growth was really building momentum. And indeed, we saw a string of good numbers, particularly around the labour market. Now, of course, we simply don't know where the US economy is. There's still some private data vendors that are producing data. But we know government shutdowns have affected consumer sentiment in the past and the consumer behaviour. And it probably will affect, at least in part, our thesis around corporate capex in the United States driving the next leg of the recovery. But we won't know for sure how this has affected the US for some time. So it buys a bit of time. It's actually probably net a positive for the Fragile Five. But longer term, the fundamental picture still remains that growth in these countries, includes India, Indonesia, South Africa, Brazil, Turkey, is still very weak. We still have macro imbalances to close. Inflation is still structurally too high, so there's a problem around underinvestment in the supply side. And essentially, we would continue to be quite cautious on the long-run equity market outlook.
Jonathan, what happens if next week the inevitable happens, which is US lawmakers, they fail to increase the debt ceiling limit? What could be the repercussions of such an event, and are markets pricing in this kind of an outcome?
No, they're not. I think very few people in financial markets would view that as an inevitable outcome, i.e. going beyond the 17th in terms of the debt ceiling. Clearly, the United States Treasury Secretary has indicated that that is an important date, though some of our own work suggests that they might be able to manage until really the very end of the month when certain bond coupon payments become due, and then, of course, we have Social Security checks that have to be sent out. But I do think if we're not resolved this by the middle of next week, the level of tensions in financial markets will ratchet up further. We've already seen volatility, the VIX, pick up. We've seen some very abnormal pricing at ultra-short maturities in Treasury bills. So it is a risk issue for global financial markets.
Jonathan, how has Yellen been perceived by the markets now? Because she's known to have a dovish stance, so to speak.
I wouldn't characterize her necessarily as broadly as that. She was certainly associated with monetary policy tightening cycles in the US in the past, and she's very driven by the data and the models. And as long as inflationary pressures remain quite low in the United States and there seems to be unused labour market resource, we're certainly likely to see the Fed remain broadly accommodative. So though we're going to get tapering, it'll be a gradual process, and the decision to hike interest rates probably won't come until sometime in 2015. So, that is an appointment that if we were not going through the debt ceiling debate and the government shutdown, probably would have been well received in terms of market moves on the day. As it was, essentially, we had a flat day in the US yesterday.
Jonathan, but we are staring at a very interesting global environment. Global liquidity in the short term is unlikely to dry up. Earlier, global liquidity was moving into emerging markets which were growing. Now emerging markets are not growing. It is still a very open debate what will happen to developed market economies. So developed market economies are not growing. Emerging market economies are slowing down. There is a lot of liquidity which is sloshing around. The question is, where will liquidity move next?
Well, there are themes in the developed world which we like better than the overall situation in EM. Europe's economy is gradually picking up. We're forecasting Germany and the United Kingdom in particular to have much faster growth next year than this year. And when we look at Japan, also there is an underlying theme there in Abenomics and a very strong series of data that we're getting, particularly on the corporate investment side, machinery orders, the Tankan survey and the like, that represents a real positive investment theme. And so you're right that there is still a pretty abundant liquidity in the financial system, but the stock market performance shows that it's moving towards those areas that have a more positive macro and micro story to tell than much of the emerging world.
Jonathan, let's talk about India. And the headline story from India is that despite a growth scare, foreigners are still net buyers into Indian equities. In fact, for the month of September, we've got more inflows and less amount of outflows. What explains this underlying interest into Indian equities?
Well, we've done a lot of work about micro performance. And when we look at the quality of business models, particularly the private sector in India, we look at return on invested capital over the cycle versus industry peers elsewhere in the emerging world. These are great business models. Particularly in sectors like software, pharmaceuticals and the like. However, what we also see is a situation where the macro has been deteriorating, which does affect sectors like state-owned banks. So good micro, poor macro really characterizes India.